Welcome to the daily update, where I'll go over the action in the market for Monday, February 3rd, and we'll see how things look for Tuesday, February 4th. My goodness, what a weekend. What a Monday. Lots of things happening. Well, this is what the majority of Americans wanted was change, and change is a coming, and things are happening pretty quick. We had a reversal last Friday in the market when the tariff concerns were coming out. And I pointed that over the weekend in all the weekend videos. Our smart money indicators were turning more negative. Well, with those indicators, we actually saw some improvements in Monday's session. Now we are weakening and we're seeing some of our indicators turn more negative. But when you base things around moving averages, we're still positive. We held with the 20 period moving average, the 50 period moving average. And what we're seeing is kind of a reverse of about a month ago when we would have nice up days, but most of the gain would come from the gap, from the previous day's close to that day's open. And then we just kind of meander around as far as price. Well, we're seeing the opposite of that now, where we see not last Friday, but a week ago, after the whole DeepSeek thing came out, we saw a gap lower, and then the smart money came in and started to buy. We saw a similar thing happen in Monday's session where we had a pretty large gap to the downside, but it was choppy and there was a real battle going on back and forth. But we saw some things improve internally. But when you look at day by day by day charts, yeah, there's some weakness that's coming in and things are going back and forth. They're changing very quickly. The market's trying to react to that, and it makes for a real roller coaster ride. Okay, let's go back and talk about what happened. Now, things gapped down on Sunday. That's when the futures start trading. The It really goes back, excuse me, it really goes back to last Friday when we closed. Well, for a while after that, the SPY and the S&P futures, they still continued to trade for a while and they kept going down. Then you had everything over the weekend with the tariffs being implemented against Canada and Mexico, and that hadn't really been dealt with yet. So then the futures opened Sunday evening, 6 p.m. Eastern time, and we gapped down. I ended up doing a video that I posted on the website where we were down about 2% at that point. By the time we opened, we were down about 1.5% or so. And that was the real damage. And then, of course, we went down after that in the open. We opened below S2 at 59.72. So we lost the 6,000 level and we declined down to around 59.30. And then this is when some news started to come out. We hit some support on the S&P, a round number, and Mexico suddenly was coming to the table and they're going to send some troops to the border and the tariffs are going to be delayed for 30 days. So the market really liked that. We actually dropped below 4.5% with the 10-year yield. Interest rates were going down, stocks were shooting back up. Didn't last all that long. We hit resistance at S2, or actually we rebounded back above S2, and then we hit resistance at S1. So we got back above the 6,000 level intraday. Then we just chopped sideways under S1, and we briefly got above S1, but then we closed back below 6,000, below S1 as well. So we ended up being down 0.76%, but to have the futures down 2%, to open down 1%, and then to cut that pretty much in half by the time we closed, it's more positive than by just looking at things going, oh my goodness, look at how the market was down. That's why I follow the futures when the market is not open. Then we follow intraday charts while the market is open because we can get a feel for what's actually happening, the whole ebb and flow between buying and selling. We were above average with volume, quite an active day there, and we are still positive when you measure this by moving averages in the short, intermediate, long term. Yeah, some weakness is coming in, and we're concerned about that. But we also saw some pockets of strength. But at the same time, the areas that did best on Monday were what we usually consider defensive areas, the areas that tend to do well when the market's getting ready to decline. So we want to keep an eye on that. That's not necessarily the trend that we've been seeing for the most part. And Monday is just one day, but is that kind of a thing going to continue? The growth to value ratios are still holding up. The discretionary to staples are still holding up. And it's a lot to do with the tariffs. There's all these cuts going on. There's all this stuff just hitting things. The confirmation hearings, news out of Panama concerning the Panama Canal. Of course, things between China and the US. It's just a real whirlwind, and things are really happening quickly, and the market's trying to keep up with all of that. So, some comments. The US did impose 25% tariffs on imported goods from Canada and Mexico, and only 10% for Canadian energy, because we get a lot of energy and oil from them, and a 10% tariff on imported goods from China. Now, I'm sure there's lots of talking going on in China, but we're not really hearing about that at this point. It's mainly because, our neighbors to the north and neighbors to the south, and we've typically, excuse me, we've typically enjoyed a really good relationship, and we still have it. And it's not so much that we don't like the people. We're just trying to get this idea that, okay, we need to do what's best for America right now. Just like Canada needs to do what's best for Canada and Mexico needs to do what's best for Mexico. And after you do that, then we see, okay, how can we work together through this and have good relationships where both sides are beneficial? And then Mexico's president came out, and is that a real Spanish name? Scheinbaum? Okay. Anyway, I'm not really familiar with much of the political structure in Mexico. Said that she had a good call with President Trump and that he agreed to pause the tariffs for 1 month. And then this was also confirmed by President Trump. And then later in the day, and even after the market closed, suddenly Canada and the US are talking. So fears continue about the tariffs because it's like, all right, this is like the old way of doing things 100 years ago. Ooh, that's a new normal. What's that going to do to the growth that we've kind of gotten used to? And what about inflation? Is this really going to boost up inflation? And you can get 10 different economists all lined up, and some say this is a great thing, some say this is a terrible thing, and then the kind of middle area, they just can't really agree on much of anything. So we're just kind of following this, letting the market work through how it thinks it's going to deal with these things, and then just adjusting things as they change. And then the growth areas decline as defensive areas saw strength. That's not necessarily what we've been seeing in the bigger picture right now, but it did happen on Monday. So we'll be watching for that. And the parabolic SAR, this is one of the areas that has turned negative now. This is a primary indicator, and that had been positive both on the daily side and on the weekly side. Well, with the gap lower, it kicked the parabolic SAR over to negative on the daily chart. And we just have one thing now that's extreme positive, and that's the slope oscillator, and it's turning down and crossing below its moving average, but it's still below a pretty high reading. And then we have the Chaikin oscillator too, that's negative now, but it's coming down after giving us a pretty high reading. And then we've got this mass index indicator as well that a few days ago triggered a signal. And maybe that's what's being played out right now because we were going up that met all the criteria of this particular indicator. And then when it finally triggers, it signals whatever happened to cause these signals. Where this indicator is expecting a reversal of that. No real change with the Fed. They're kind of like on the back burner right now, even though they met last week. But a lot of the talk is, and I'm sorry about my voice here. A lot of the talk right now is geopolitical and then domestically all the changes that are taking place. So no real change to that scenario. The dollar was up. Now with these tariff talks, that really boosts the dollar. We got up into the 109 range again. We're back into the 108 range now, but that's really been strengthening the dollar. So you want to go traveling. Of course, you may not want to admit you're an American right now if you're going to Canada or Mexico, and I understand there's possibly even some things in the works for the EU. So yeah, the things are getting ruffled right now, and there's going to be a lot of change going on. Whether you hate the guy or love the guy, he's a negotiator, and that's what he's taken upon himself to do, to ruffle and mess up and totally stir up the pot for what's been going on for decades, and in some cases like 100 years or so in the US, and try to make some changes from that benefit America. So, and there's so much misinformation. And even if you're informed about these things, it can still be really confusing because things are happening so fast, and it is a new mindset. It's a paradigm shift of things that are going on. And so things that we looked at in a certain way for a long, long time, now that could be shifting to something different. And even though change is usually welcomed and it's what we all want, it can be uncomfortable as it's happening. And we're still trying to figure out, is this a positive thing? Is this a negative thing? Well, everybody has their opinion, but very few folks are really informed as to what's actually going on. And I like to think that I keep up with things, and it's like, oh my gosh, what's happening now? But anyway, the dollar was up, interest rates were down. We actually got under the 4.5% level for a while, and I've been following an intraday chart, a 10-minute chart, and I'll show you that because we dropped below 4.5% right about the time stocks started to bump back up. No, we didn't close below 4.5%. We're at 4.54% with the 10-year yield, but we're getting closer to that level. When we started to go above 4.5%, that's when stocks noticed and began to have some issues with interest rates going up. If we can go down with interest rates, that might help things. Where after Friday, we were at 4.57%. Sentiment is negative, but we're just coming out of being neutral. We're not totally negative and we're not positive. We're just drifting around right in about the middle on the scale of 0 to 100, where we came in at 44, where we had been at 46. 46 was neutral. We ticked down below 45 to 44. Now we're going to negative. And we're switching over negative again with our ADX. That was one of the things over the weekend that I was pointing out. The green line was still above the red line on the ADX chart. Well, now the red line's come back above. So we're switching negative there, but we're still not trending. We're chopping around right now. We go negative for a day or two, and then we switch back to positive, and the ADX is just kind of flatlining underneath 20 and underneath its moving average. So there's really no trend to speak of on the short, intermediate, and even long term. And I showed some of those charts over the weekend. Because of the down day, our bias is negative, and the momentum over the last few days, I'm still keeping mixed to negative because we're seeing pockets of strength under the surface that are not coming through to the actual price of the index itself. But I'll go through the charts and show you what I'm picking up here. So the economic reports that came out, I don't have a chart for this one. The takeaway is S&P Global US Manufacturing. The final reading came in at 51.2. It's above 50, so it's showing some expansion that way. Where in the previous reading it was at 50.1. This was the big one, the ISM manufacturing. For the first time in a long time, we're finally getting a reading for manufacturing that's coming in above 50. And that's showing economic growth right there. So it's at 50.9, not much above 50, but it is above 50 nonetheless. They expected it to come in at 49.1, which would still show contraction. And then the last reading was at 49.2. Construction spending was up 0.5% more than the 0.2% that they had expected. And that's the same reading that we had last time. All right, so here's some charts. Here's the ISM index. The total is the blue line. It's kind of hard to see. It's actually coming up a little bit here, but it's right on top of the orders, which is the yellow line, where orders are actually coming down. And then the prices and deliveries, where we're seeing a decrease in prices and an increase in deliveries, which is kind of, that's not necessarily inflationary. Prices going down and they're delivering more. And then imports versus exports, a drop off in the exports. Well, there's going to be a drop off in the imports too. And it did decline here, but not by very much. And then just looking at the index, we're dropping down a little bit here on a month over month reading. And construction spending year over year, still positive, but we're below that 5% level. And construction spending, residential went up where non-residential was flat. And then month over month, we did see a pickup in the overall construction spending. Okay, some interesting charts here. The US share of global indices has risen recently. Well, kind of having a little bit of trouble, so this percentage might be a little bit less right now. But it's 56% of the global equity market, and that's really not a surprise there. And also coming in with 44% of global earnings. And we have the strongest economy, and that's why we have the strongest stock market. And market cap, this is the rest. Now, really, there's 503 stocks that make up the S&P 500, but they have the Magnificent Seven and then the 493 that are left over. And these stocks have been lagging, but we've been seeing that now for quite a while. This goes all the way back to 1980. So it's really being driven by a smaller core of stocks. Those big stocks are really increasing in their market cap, where we've actually been declining with the rest of the stocks that make up the S&P 500. Happy new month. This goes all the way back to 2000 with a 10-month moving average here. This is a very long-term trend. I even have other charts that are even longer than this, but we see the black line, which is the S&P, and then the blue line, which is the moving average, and we're above that, and both lines are going up. So very long term, we are still positive. And then U.S. tariffs, this kind of gives you a breakdown on the history of those. Really, going back to the 1950s, pretty much post World War II, there's been very few tariffs in the U.S. This goes back further in U.S. history. You're going into the 1700s, a lot into the 1800s, and then right around in the Civil War time. And this is how the government really got its money. And then we had the Federal Reserve Act and the U.S. income tax created in 1913, and that changed a lot of things. And then we saw a gradual decrease in the tariffs as we were trying to build things in a post-World War II type of an environment. All right. Aggregate U.S. equity futures positioning coming down a little bit, but still pretty high right now. These are leveraged funds, so it might be on margin. It might be like the ETFs that we have that are juiced, where they outperform to the upside. We're seeing a bit of a decrease in that, but still a pretty high reading overall. And then dollar resumes rising trend as U.S. tariffs imposed, and that's typically what happens. When a country does things that are supposed to be for its own good, its currency tends to do better as well. But the stock market likes a weaker dollar, and I constantly point this out because of exchange rates and import-export relationships. It looks better when we have a weaker dollar. And the official stance of the US government is we have a strong dollar policy. The unofficial stance of the US government is that we have a weak dollar policy, but it's been holding up fairly well right now. And some interesting things I ran across. This is, if you grew up in the 70s like I did, I used to subscribe to Sports Illustrated, and there used to be the Sports Illustrated cover curse. Well, it's kind of drifted over into Forbes now, where back in the day, if some athlete was really having a good season and they put them on the cover of Sports Illustrated, it's like everything fell apart after that. Well, it's kind of happening now with Forbes, where you can see some of these folks here have kind of gone by the wayside as far as being at the leading edge of what's happening and only to fall from grace. Well, look at who's over here on the left-hand side. I don't know, maybe it'll be different this time, but some of you, we recognize who these people are and how they were once high flyers, but since then things have changed dramatically. All right, and then Chris Schiavocco posted this. He's more of a bigger picture person than I am because he's a money manager where I'm an educator. And he's a real fan of these volume weighted moving averages. I call them anchored moving averages that move forward. And even with the declines that we're seeing here, we're still seeing these anchored moving averages going up, and we haven't even come down to them. In fact, one actually acted as support. So this just shows in a bigger picture sense that things are holding together pretty well. Then here we go. And you don't know how long this is going to last, but because all this stuff was announced and then everybody was freaked out, and then all of a sudden, because Trump's a negotiator, people are coming to the table like Canada and Mexico and so forth. So here we are. I survived the 2025 global trade war, the 3rd of February 2025 through the 3rd of February 2025. I just thought that was kind of clever. But there's more still to come with that. This is far from over. It's just a step-by-step process. And then this is looking in a way at comparing where we're at now with where we were during the dot-com boom. And the takeaway at the top here is that the earnings are a lot better. It's just price has become a bubble. I'm sorry. The earnings are a bubble, and that's driving price up. Sorry, I got that backwards. We're back in the dot-com boom. There were no earnings, and price was the bubble. That's what I said in the first place. But so to try to compare what's happening now with what happened in the late 90s and into 2000, it's a lot different. It's similar, and you can draw some parallels when you're looking at charts and things like that. But the background, the underneath the surface, there's earnings now that weren't there back in the dot-com craze. And so I see this as more positive now, because these companies still exist, but there's a tremendous list of dot-com companies that didn't exist too much longer after they became all the craze for a while, like pets.com, furniture.com, and there's a host of others. And then this is a little bit of a concern. This is US relative to the world as far as earnings per share revisions. And when this is going down, that just means they're revising the earnings lower in the US faster than they are in the rest of the world. And you can go back a little bit in time, and when we turn red, quite often, doesn't, I mean, we were doing really well in 2007. It's 2008 when everything fell apart. And we had a pretty good run here through the mid 20 teens or so, but a little bit of a concern now that earnings revisions are being revised down, at least when you measure it this way. And then U.S. manufacturing expands for the first time. This is what I'm alluding to with the ISM manufacturing. This breaks it down a little bit more, where the purchasing managers index is going up and getting back above 50. The new orders are going up, productivity is going up, and employment's going up there. So we are seeing some manufacturing strength. Now, we're going to be getting the services report coming out this week as well. And that's already been above 50 because the US has been more of a service type economy after we had been an industrial economy. And before that, we were an agricultural economy. And we've just shifted over a little bit. But so it's kind of encouraging to see these numbers improving a little bit. Then government receipts from tariffs rose substantially in response to 2018-2019 trade war. Well, gee, I wonder who was president during that time. And this was talked about a lot then. And the government brought in a lot of money from those tariffs. And now with Trump 2.0, he's doing these things again, not so much to make money, although you have to, the government needs to bring in money, but it's to try to change the overall climate to disrupt the status quo and have things in a more efficient manner. I mean, Doge is just going through and just hacking up things like crazy. All right, and then another thing that happened that kind of got lost in the shuffle, the new Secretary of State, Marco Rubio, went down and talked to Panama, and which is pretty much the Panama Canal, which the U.S. built, and then gave control over it to Panama. Well, China had come in and they're setting up businesses all around the Panama Canal. Rubio went down there and talked to them and says Panama pledges to end key canal deal with Japan, or excuse me, Japan, no, China, work with U.S. after a Rubio visit. And that could be a big thing for the U.S. I mean, you want to get some ships, whether they're hauling cargo or soldiers or weapons from the East Coast to the West Coast as soon as possible. You don't want to go down around South America. You want to go through the Panama Canal. And if there are some problems between the US and China, and they have a lot of control in the Panama Canal, that could really mess up the US. So this is more of a strategic thing as well. All right, let's go back and look at the chart. And been a crazy day. I mean, my goodness, we were up here on Friday's session. We hit this overhead resistance, and this is when things started to really show some weakness going into the close. Then we had the gap open lower down below S2. We finally found some support, and this is right about the time that it was announced that Mexico was coming to the table. We saw a nice little bump up from that, but then we hit resistance here at this S1 level and then just kind of trailed along. We tried to get above S1, but then we just kind of fizzled down going into the close, and we're still under 6,000. And intraday, again, I was watching these things. I mean, look at the big fall that we've been seeing here, but then we're bouncing back too, and we're up in the initial overnight session, at least after the market closed. So, yeah, things are taking a hit right now, but they're not necessarily falling apart completely. Still looking good here with the blue line above the red line. That just means growth, which is when the market goes up, is still outperforming value, which is the red line. And then still holding up fairly well here, where we came really. This was the big day when DeepSeek was announced a week ago, Monday, and we've been climbing back ever since then. So this is still holding up fairly well on an intraday basis when we look at S&P growth to value. And then end of day, everything was down. In the middle area, these are the ETFs for the large caps, mid caps, and small caps, where growth was down more, but well off. It was down over 2% not too long after the open. And so it repaired a lot of damage there. It was down less for the mid caps and down less for the small caps. So when we look at our charts, we actually showed an improvement between the growth to value ratio here for the small caps. Not doing real well with the index. And I've been harping on the fact that we couldn't get above the 50-day moving average. We're kind of far away from that now. And we went up with the mid cap growth to value end of day chart. Even though the index is really suffering right now, S&P growth to value ticked up a little bit, but still holding together. And this is under the surface. And when growth is outperforming value, this shows that there's some buying coming in because growth stocks are buy low and sell high. Value stocks outperform when the market's getting ready to be more defensive, meaning going down. And we're not seeing that yet, at least on these charts. A little bit of a decline here when we look at the growth versus value ETF. This is a little bit of a concern, but it's not necessarily confirming what we're seeing with some of the other measures that we use. Discretionary to staples, yeah, it came down a bit. Staples, getting more defensive there. Um, so we came down in Monday's session, but the bigger trend is that discretionary is outperforming staples. Large cap growth coming right back up to its 50-day moving average. And then as far as our trend, just way below 20 here and still declining and still below the moving average. The green line was on top. It's now dropped below the red line. So now we default in the intermediate term here to negative. And in the short term, we're also seeing the red line crossing above the green line as the ADX continues to drop. Volume is still below average, or I'm sorry, above average. And then this is the weekly chart here. We're still coming in pretty high with this particular sentiment gauge at 71.88. And then we look once a week too at the legal insider transaction ratio. These are the corporate officers, president, CEO, the folks that really understand what's going on within a company. And they had been giving us a really high reading here, which tends to be bearish. It's really coming down now, but it's still on the bearish side of things. And when I show that chart, I also show the insider buying ETF, where it's coming back above its 50-day moving average. Okay, the VIX did go up. We were in danger of going above 20, and that's when things can really turn more negative, but we were able to stay back down below that, even though the VIX did go up, both on a closing basis with the line chart and then with the bar chart. We did peak above 20, at least right at the open. And when the VIX goes up, the VIX of the VIX also goes up as well, as fear's been coming back in. We're starting to turn up with the momentum of the VIX, and this could be more negative for stocks. When the VIX is going up, that means stocks are going down, and vice versa. So, as measured by this momentum indicator, that's starting to turn back up. We're still getting a high reading. This is a variation of the VIX, and we're in the red area. We still have not been able to drop down out of that. We've been up there for quite a while now. We ticked down with this other fear gauge and we went up with this fear gauge. So we're seeing a bit of a mix as far as fear coming back into the market. I don't have these updated. I'm having to record this earlier than usual due to a obligation that I have. And these are the last charts to update every day, and I couldn't wait around for them to update. So the equity put call ratio charts are not current and not really showing a lot of fear coming into the market here with volatility risk premium. Again, when we really spike up with this, that's usually when the market's really getting ready to go down, and we're still getting a relatively low reading here. All right. We're seeing some deterioration of the advanced decline line based on price and volume. A little bit more going down based on volume. Want to keep an eye on that, but we're still above these longer term trend lines. So in the bigger picture, we're still positive. We're coming down with the advancers minus decliners over a 10-day period after getting a really high reading, but we're still above zero with this indicator. So it's still positive, but it is declining. Starting to see a rollover here with our 5-day moving average of the highs and lows. Saw a real contraction of the new highs and a bit of an expansion of the new lows. So the 5 days turning down and the 10-day is starting to turn down. This is showing some internal weakness coming into the market. We declined with our short and intermediate term advanced decline ratio, but we're still above zero. And I don't know what's going on here. We actually went up with the accumulation distribution, but the boom indicator is going down. So disregard this indicator here. We actually showed some improvement, and this is a smart money indicator. This means that the money that really controls the market, they're coming in and doing some buying because this indicator takes not only price, but volume into account. And we have three of these indicators. This is indicator number one. The chicken money flow did go up and we're starting to turn back up. Where after Friday, it was down. This line was going down and the histogram was going down as well. It's now turning back positive. And this is what we saw a week ago with the huge gap lower open. Well, the smart money started to come in and buy. Now we're still negative here though with the chicken oscillator. We had been really extreme coming down, not really seeing an improvement there. So we're getting a bit of a mixed picture now with our three smart money indicators. Two of them showing improvement. This third one here is still negative. And we came down, but we're still positive with the vortex. And not much of a change here. The cumulative advanced decline line for the S&P, not much of a change. We are falling a little bit more based on volume. And when volume leads price, either to the upside or the downside, we want to make note of that. And not much of a disconnect here between the S&P and the NYSE advanced decline line. We're coming down with the S&P. Also saw a decline here with the NYSE advanced decline line here. Coming down, but still above the moving average with the cumulative advanced decline line for the NYSE. Our regular advanced decline line declined, but still above the moving average, and we're still above the moving average here on this other NYSE advanced decline line. When we break it out based on common stock, a decline based on price and volume, as to be expected there. Starting to drop below the moving average with NYSE common stock, declining but still above the moving average with the S&P. So that's looking a little more positive. We're still above the moving average with the mid caps, and we're dropping below the moving average with the small caps. But the S&P is the one we focus on the most, and even though it's showing some weakness, is still above this blue line, so it's hanging on to being positive. We're still above zero when we take a 5-day moving average of the highs minus the lows across the broad market. And we are seeing some weakness here. We're dropping below 70 with those stocks in the S&P above their 20 period moving average. That's the short term. We had come up above 80 and now we've been starting to decline. That's suggesting some weakness. This won't really turn negative unless we drop below 50. But the context is that we are declining now and we're dropping below 70. This is the same thing, but I just have it's a different color chart and I have the 70 level marked here where we're seeing some shorter term weakness. We're dropping below 50 with our 50 period moving average steady. That's intermediate term. And we're just barely below 50 with our 100 period moving average. That's intermediate to even somewhat long term. And we're declining, but still well above 50 with our 200 period moving average steady. And now you can see this a little bit better since these pivot points have been kicked out off to the side. We're still hanging on to the 50 period moving average with the S&P, and at the bottom we were above average with volume. Coming down with our 20, 50, and 200 period moving averages on the S&P. We're dropping below the midpoint with a short-term oscillator. Yeah, this is an oscillator. It's below the midpoint, the Stochk RSI. Also dropping, but still above the midpoint with another oscillator, the Williams percent R. Coming down below the midpoint with the CCI 14. Still just a little bit below the midpoint with the CCI 20. All of these together are the short-term indicators that we use. And the fact that they're not extreme positive or negative also confirms that we're just not trending right now. Nothing's extreme with the with the stochastic. We're coming down after being extreme with the short term. This is a further subdivision of the short term time frame. Coming down in the intermediate short term and dropping down now, but turning a little bit more negative with the long short term stochastic. Dropping below zero with the force index, dropping below both lines here, the green line and the blue line, with our short-term moving average condition, but we're still above the simple moving average based on 20 periods. That support level has held. That's what's keeping things positive in the short term right now. And we're below the midpoint with our standard deviations chart as we're seeing some deviation to the downside here, or actually from the upside. The balance of power did come down, but we're above the midpoint. We're turning more negative here with the go, no go. The dark blue is positive. The light blue is turning more negative. And we're dropping below the midpoint with our highest high, lowest low value chart. And we're now going down for the second day in a row here with the TTM squeeze after coming up to this black line. That's turning more negative there. We're declining, but still above zero with the ease of movement. The Erin indicator is still out to lunch. It's been flatlining over the last number of days. And we're barely positive here with the McClellan oscillator for the S&P. We've been declining, so that's negative. But when we're above zero, that's still considered to be positive. When it's above zero, we're still going up based on price, even though we're starting to roll over. But we're seeing a negative divergence here because for the second day now, we're declining based on volume. We want these two to be going in the same direction at the same time. We're still basically going up based on price. We're declining based on volume. That's a concern. And we're dropping below zero now with the broader market of the NYSE McClellan oscillator. Really hard to see, but we're starting to turn down with the summation index based on price and volume for the NYSE. This has been negative all along. Going back to a week ago Friday is when this hit a really high reading and started to come down. We're dropping below zero based on price and volume when we look at the Swenlin trading oscillator. Momentum is still positive, but showing some weakness. Here with the PMO, we're also rolling over based on price and volume and coming down with the PMOs that are rising after giving us an extreme positive reading. Also coming down with the buy signals after being extreme positive. Still kind of going up here with the PMOs that are above zero. And we've gone from neutral to negative with the Elder's Impulse system for the S&P. This is a big one. The dot is now on top with the parabolic SAR, where when we're underneath, that's positive. When the dots are on top, that is negative. And we're dropping below the 50 period double and triple exponential moving average here. This is the condition of our intermediate term trend. When we're above this and the lines are going up, that's positive. Now that we're dropping down below this, that's turning it more negative. But when you look at the simple and exponential moving averages based on 50 periods, we're just a little bit above the simple moving average here. So the short term moving average is holding and the intermediate term average is holding for right now. Are we going to be able to bounce up off of that? If we lose these, that's going to turn things back more negative. And then here's all of the spaghetti mess of moving averages. We had the 20s coming down. The 20s and the 50s are still kind of close to each other, but these support levels are holding. Now you have the exponential moving average here based on 20 periods. We did lose that, but most folks tend to follow the simple version of the moving averages. And we're rolling over with the slope oscillator, but we're still above this green line. So it's extreme, but turning negative. Rolling over here with the MACD, but hasn't crossed below its moving average. This is short to a little bit intermediate term. And then I have a whole slew of momentum oscillators. The two short-term ones are starting to turn negative. Intermediate term rolling over, but haven't crossed negative. We're still positive with our long-term momentum oscillators. The copy curve is still positive, but rolling over. Another momentum oscillator. Coming down back into this more yellow area now with the Sean trend meter. And the context is that this has been coming down. And we tick down just a little bit here, but we're above 50 with the money flow. We're declining, but also still above 50 with the ultimate oscillator. Declining, but still above the moving average with on-balance volume. So you can kind of see there's some positive things, but there's also some negative things that are starting to develop now. We're still, well, I guess we dropped a little bit below 50 here with the RSI 14. That's more intermediate term, where we're dropping below 50 with the short term RSI based on 9 periods. This is the mass index. There are three criteria that need to be triggered. They've been triggered. We're waiting to see, is this leading to the reversal? But we're not trending yet. I mean, we had a big down day on Monday. What's going to happen on Tuesday? Are we going to go back up a little bit and just keep going along in this non-trending environment? But we're still working off of the Pring bottom fisher buy signal. That still continues to be in effect. And we're declining now with the bullish percent index. After Friday, this was still looking positive. Now it's turning more negative and we're dropping below the moving average. We're technically still positive since we're above 50, but we also look at the context of the line, and that is going down. And we're coming down, but still above 50 with the NYSE, the broader market measure bullish percent index. And we're declining, but still above 50 with the NASDAQ 100 bullish percent index. And we're coming down into the 20 period simple moving average of the open high low close, kind of right in the middle of this little mini rainbow right now. If we drop down below this, naturally that would be more negative. If we can bounce up out of this, these lines are still going up, and that would keep things more positive. And this is very long term, going back to 2009, where we're still hitting the upper end of this trend channel. And for the time being, it looks like this is providing overhead resistance. And we're turning negative. We're seeing a mixed picture on these charts. Turning negative here with the Heiken Ashi chart. That's a black candle. We're pointing down in red with the Kegi chart. That's negative. But we're still positive with the Renko chart with the open blocks. And we're still positive with the three-line break. So we're splitting the difference. But when we look at the point and figure chart, we had a couple of new O's drawn in here. This had been looking more positive after Friday. We still had these X's were the last thing to be drawn into this chart. With the decline, this is more negative on a price basis here. Long term, seeing a bit of a hit with our 150 and 200 period moving averages, but still above this blue line. That's keeping the longer term still positive. And we're negative across the board with the S&P, mid caps, small caps, and QQQs. We've switched over to negative in the intermediate term with the decline that we saw on Monday with the small caps. They just have not been doing what folks really thought they should be doing right now. And so stocks are negative in the short term. We've actually changed to, I haven't seen this in a while, short-term uptrend with bonds based on price. Still negative in the intermediate and long term. Commodities are doing well, and the dollar is back to doing well again, too. And you can see here, looking at the split between the different sectors, there's 11 sectors that make up the S&P 500. And we see tech, discretionary. These are growth areas. We want them to do well. They did the worst. Where we have energy, utilities, which that's a flip of the coin right now, whether utilities are a growth area because of AI and because of electric vehicles and Bitcoin mining and all that stuff. Healthcare is another defensive area, and staples are defensive. Communication was actually up. That's a growth area. But these top four are usually more defensive. We're going to be watching these to see if this continues. That means the market is getting more defensive. And an awful lot of red. Just one blue or green area. Utilities had a BPI cross above 50, where last Friday they crossed below 50. But an awful lot of red here between the S&P, the Nasdaq dropping below all these levels. And you can see a lot of this action happened right as the market was opening. It was pretty much all done, except for, and this didn't end all that. This was during the first hour that the market was opened when all these things happened. And looking at the weighted versus equal weighted version of the S&P, both are declining right now. The Dow is holding up above this pivot point here that held as support, and we closed well up off the low and above the 50-day moving average. So that's still hanging in there for right now. The diamonds are still neutral, though. That's the ETF that goes with the Dow. The Nasdaq is now dropping below its 50-day moving average. That's more negative, as is the Nasdaq 100, but made a nice little attempt at coming back. Closed well off the lows and gone from neutral to negative with the Qs when looking at the Elder's Impulse system. That's the ETF for the Nasdaq 100. And momentum is starting to turn negative now with the Nasdaq 100, where it had been positive. And we dropped below the 20 and 50 period moving averages, but we came back up to the 50 period moving average for the Q. So this is another support level that's holding. Small caps falling further below their 50-day moving average. And now this is the other small cap index that we look at, the Russell 2000 dropping below 50 with the RSI well below the 50-day moving average now, rolling over but not quite negative with momentum. And we've gone from neutral to negative with the small caps. Mid caps holding on to their 50-day moving average after Friday, lost that on Monday. That's more negative. And we've gone from neutral to negative with the Elder's Impulse system for the mid caps. Declining, but still above the 50-day moving average with the financial sector, but dropping back below the 50-day moving average with the bank ETF. We want to keep an eye on this. There's some folks out there that are really anticipating some kind of a banking problem that really hasn't, well, we had it a year ago, but it's not at the forefront right now because we've got interest rates going up. You've got these banks that are having to roll over debt, including the U.S. government that financed with shorter term debt at lower interest rates. That debt's going to have to be refinanced at higher interest rates, and the banks are running into some problems with that too. That's why we want to keep an eye on these charts to see if it's telling us something. The Wilshire right at its 50-day moving average. So that support level is holding a broad market measure, and we're back up to the 50-day moving average with the total U.S. stock ETF. So these support levels are holding for right now. The FANG index didn't even come down to its 50-day moving average. These are the mega caps: Facebook, Apple, Amazon, Netflix, Google, Nvidia. This is holding up and wasn't down as much as the rest of the market. And so we're still holding up above this longer term trend line here. Will that support level hold? So Apple was down 3.39%. Amazon was down 0.11%, virtually unchanged. Microsoft down a percent underneath its 200-day moving average. Google was down 1.37%, but still looking pretty solid there. Meta was up over a percent. Yeah, hitting a new all-time high again. Nvidia dropping further below its 200-day moving average. And Tesla was down over 5%, dropping below its 50-day moving average. So you take these all together, and that's why we're seeing some pressure on the indexes right now. And then Netflix was actually up 0.22%, but has been chopping sideways lately. Seeing a real drop off here when we look at US compared to world stocks on a short term basis, and we're leveling out with the longer term correlation. Oil did go up. We're watching that mainly for geopolitical reasons. If things really escalate in the Middle East, and there's a lot of stuff going on there too, but it's not at the forefront of the news cycle right now. So oil did go back up a bit here, and we're seeing the dollar in an uptrend. Came down, kind of held at its support level on the 50-day moving average and is now starting to go back up. All right, semiconductors, disappointing here, coming back down closer to this 250-day moving average. Not really showing any strength at this time. And why am I showing oil again? Okay, in case you missed it the first time. And the dollar. Well, I got rid of this before. I don't know why I'm showing these same charts again. All right, so we were down a little bit. Now, I know it looks like we were up here, but from close to close, we were actually down with the 10-year yield. We did fall underneath the 50-day moving average. We did fall under 4.5%, which on this chart is 45. But then we bounced up from that. And here's the intraday chart where we were really dropping down here. This is when we dropped below 4.5%, that's when stocks started to shoot up when the announcement from Mexico came out. But that didn't last very long. We went back above 4.5% and actually went higher, even though when you compare the close here on Monday with the close on Friday, we did decline overall. And so we are going up slightly here with the 7 to 10-year bond ETF. And this is still a concern too. Home construction to 3 to 7-year bonds really going down with this ratio. And we're keeping an eye on the Japanese 10-year yield. If that continues to go up, that could cause the end of the world day like we saw last August. So if this red line just really starts to move, that could also come in and cause some problems for the market again. And seeing a little bit of an improvement here with our growth to value ratios. We want growth to outperform value. That's when the market's really going up. We did improve a little bit, but we're still below a declining moving average with the Qs to S&P ratio. Coming down, but still above the moving average with discretionary to the S&P. Still under a declining moving average when we compare large cap growth to large cap value. So the large caps are decreasing in value here, at least according to this ratio. We're going up with the mid caps and crossing above the moving average with the small caps. So somebody's coming in and doing some buying in growth stocks. It's holding up okay with the large caps, but we're actually seeing an improvement here with the mid caps and small caps. All right, so what's our outlook? We're positive still when we use moving average to base that around. But you can see there's definitely weakness coming into the market, and we're not trending. And a lot of this has to do with what's this whole tariff thing going to do to the US economy, to companies, to stock prices. And you've got a real confused group right now who participate in the stock market. We're going to get factory orders and JOLTS job openings. Now, this is the week for employment data. We're going to get the employment situation report on Friday. And then I've added tariffs to the list here, but all the different geopolitical things that could have an impact at any time. But right now, it's more focused on what's going on in the US. So here on Wednesday, we will get the ISM. That's the services part, where we had the manufacturing report on Monday. And we're going to get jobless claims on Thursday, like we get every week, in productivity and unit labor costs. But then the big one's going to be the employment situation report on Friday. And here's another look at the upcoming economic report calendar. Seasonality, we're neutral to positive with the Dow for February 4th, where we're just flat out positive with the S&P and Nasdaq. We'll see if that matters in Tuesday's session. The first half of February tends to perform fairly well, and that's where we're at right now. Where the second half tends to, after the Super Bowl, after Valentine's Day, a bit of a letdown with all those things. And baseball hasn't started yet. They're only getting ready to go to spring training, so a little bit of a drop off there. And small caps just not even coming close to what usually happens with them during this time of the year. And then we do see more positive action the first part of February, where we see more weakness going into the latter part of February. And this is February, the worst month in a post-election year. That's the black line going down here. So if we do turn more negative, that's historically what has happened when we have a post-election year. All right, so the warning signs. Now, some of these are actually looking a little bit more positive. We're going up with accumulation distribution. We're going up with the Chaikin money flow, but we're still negative with the Chaikin oscillator. Because we're getting a mixed picture, I decided to keep it on this slide. We're still declining with the Swenlin trading oscillator based on price and volume. The parabolic SAR, that's a new addition to the negative slide here. And we're still positive with the 20, but we're dropping below the midpoint with the 50, 100. We're still declining with the 200, but positive there. So we're seeing some weakness with our moving average studies, and with a few of them turning negative. And then we've got this mass index thing. Is that going to mean something? But it's been around for a few days now, and we've had up days and we've had down days since it triggered its signal there. And we're turning negative with the NASDAQ 100 momentum. Positive. Still have a fairly good list here. Growth of value still holding up when we look at the mid caps, small caps, and especially with the S&P. Some areas not performing as well, but other areas still holding up. Discretionary to staples showing some weakness there, but still holding up fairly well. And I don't know about the equity put call ratio there. The advanced decline lines, we're still positive with the S&P, but we're dropping down. We are showing some weakness there. The ease of movement is still positive, and the volume is declining here with the summation index. We're still going up based on price, and that's a negative divergence. And we're starting to roll over with the NYSE McClellan oscillator and summation index as well. And we are still positive with the momentum, but it's weakening. We're rolling over now. And getting, I have it on the positive side here because we're above 50, but we're declining with the bullish percent indexes. The vortex declined, but is still positive. The money flow, the ultimate oscillator are still above 50. And the financial sector is still positive for the time being. So, our conclusion, we're positive. We're not trending. There are these tariff concerns going on, and that'll get replaced by something else. It's just a really big deal for this particular news cycle. And in the meantime, weakness is developing in the market, and we're not trending in the short term. This is where we're seeing some weakness, and we're seeing that same thing in the intermediate term, but we are still positive in the long term. Thank you. I really hope you found this helpful. Have a really good day, and I will talk to you in the next video.